they're gone.
Of course.
All right, everybody, listen up. Welcome to Project 321, where we're bringing you raw, unfiltered conversations with the people who know their stuff. Today, we've got a heavy hitter in the house, Sam Parker, CEO of My Credit Guy. This guy's been the credit ninja. He's helped thousands of people understand, fix, and master their credit. You want to know how to hit an 800 score, avoid big mistakes, build your dream financial future? Sam's got the blueprint. But here's the deal. Don't just sit back and watch. This isn't Netflix. Drop a comment, hit the like button, and share this with somebody who needs to hear it. So without further ado, thank you, Sam, and my good friend and colleague, Tom Mancuso.
Sam, thank you for joining us. You're awesome as usual. So there's a lot to get to, a lot of your background, things like that. But I want to hear the good stuff. What's the craziest credit story you got? I know you've helped thousands of people, so I know you've got a great story.
Oh man, I got all sorts of stories. I got good stories and I got crazy stories. The craziest story is back when I first started in credit in my early 20s. And there was this one investment buyer that kept on just bringing us credit repair deals. And she would say, I want to just pay for them for my clients. Just go in there. They have mortgages on their credit that shouldn't be there, and we just need them off. Okay. Well, we were like, okay, well, we'll go to work, and we would usually be able to go in and using just general verification, date of birth, address verification, things like that. We would dispute these mortgages and be able to get them removed. Then all of a sudden they stopped coming off, and we were wondering, like, why is this just so consistent with this lady's clients? And what turned out, and we had to help in an investigation, is that she was using her past clients' credit and information, and this is in the early 2000s, to buy homes. But then she would sell them quick enough. They would be like, I guess, fix and flips, and she would fix them up and sell them really quick, and then have companies come in and help them get them removed. And then finally we were the ones that figured out what was going on, and we actually had to report it and everything, and then like give documentation and evidence and all that good stuff. That was the craziest one, where it just made me be like, how do people think of this shit?
That's wild.
That's wild. That's crazy. So how did you originally, you said you started this in your 20s. How did you get into kind of the credit world? Like, where did that start?
Yeah, I have the most unsexy story of how I got involved. So I was in between semesters in college. I was just working, and I worked at MCI as a telemarketer at night. And at the time, it was really big because local and long distance had just been combined, and you could pay for unlimited long distance. It was a big deal back then, right? So I was calling, and I got pretty good numbers. I was up at the very top in the whole company. And so then I got recruited to go work at a marketing company there in town. And then from there, Jesse and I, who you guys know, both were recruited by a financial services company to run their sales and marketing. And we're 20. And so we're like, this is everything. Like, we're going to college to run a sales and marketing team. Like, woo! So I go and we meet these guys, and they commit, and they're going to pay us $800 every 2 weeks plus some commission. And we know with commission, if we just hit the phones, like, we'll do what we need to do. Okay. So, but again, financial services, they tell us that we're going to be like, and I remember at the time being like, I don't think I'm very qualified for this, because they're like, you're going to be like learning about financial products and walking people through like their savings and stuff. I was like, I don't have very much money myself right now. So anyway, I drop out of school. We show up at this thing, and all it is it's a startup credit repair company. It's not financial services, it's credit repair. And we don't even have a computer. All we have is like inches thick of paper. And all they are, it's just data from Experian at the time of people who had less than 620 credit scores. And so I went from thinking that I was like going to be like running, like creating commercials, maybe. I don't know. Like I was just letting my brain spin. I really thought it was going to be something cool. To all of a sudden, like I'm just a telemarketer calling people that absolutely don't want me to call them with less than 600 credit scores. And I don't have a good reason to tell them why I'm calling either. Like they're like, well, how'd you get my name, or why are you calling? I'm like, because your credit's low and these guys bought a list, basically. And that was so painful. Okay, so after the first day, Jesse goes, this isn't what you guys said it was going to be, and he went back to the marketing company that we were both working at, a nice safe job, and he worked there for like 8 years and climbed the ladder there and everything. Okay, I was like, well, I don't have that opportunity, so I got to make this work. So after a couple months, I said calling people at their house is not the way to go. I'm going to start calling mortgage professionals and make sure that these people actually want our services and that we're dealing with motivated people that we can actually help. So then that's how I kind of switched it over to the mortgage industry. And then there's a whole nother story after that because I left that place pretty quick.
I love that. I never knew that. That's so awesome. I got to give Jesse a hard time about that. You
Yeah.
literally like walked into like the Wolf of Wall Street credit repair, like the penny stocks. Like that was you, like handed you like a list. Like just call these bad credit people.
Yeah, it was rough. And the crazy thing is I made it work at the time because I'd call them up. I'd be like, I mean, the bottom line is you have less than perfect credit. And what we do is help you. And, you know, it wasn't long until I realized that that place was run by a guy who actually was in the process of starting a mortgage company. So my plan to switch it over to cater to mortgage lenders and his plan to run a branch out of the back side of this, they ran into each other pretty quick, right? And so then that's when I left there at 21 years old and we started American Credit Repair.
Okay. To so many people, credit scores are just a complete mystery, right? I mean, even the people who think they know are sometimes the most dangerous because between all the different types of scores and scoring systems and reports and FICO 9, and did you have any clue it was that complicated when you started, or did you think it was just cut and dry?
Oh no. I mean, it took me 2 months in the credit repair business until I finally got up the nerve to say to this other guy in the office, I was like, look, I know what a home loan is, but what's a mortgage? Right? Like I didn't know anything at all. So I learned everything along the way. And I had no idea that it could possibly be this complicated. So that's why I come from a place where there's not too simple when it comes to credit education. And a lot of people think that, especially in the mortgage industry, like we assume, well, surely they at least know this. And it's like, really, when did you learn that? And it's like, not until it either hit you in the face or until it was part of your profession, right? And so, no, I did not know that it could possibly be this complicated between FICO and Vantage and the different models of FICO. And then if you do this, which seems like a good thing, you pay a collection off, your credit scores drop. Like, how could that possibly be? So there's a lot of things that were tough to learn along the way, but they're important to know.
I can see that. So like, let's kind of break it down for the people that are listening. What actually goes into a credit score? Like, how does that model work?
Yep. So as of right now, you got basically 5 sections. You got a pie graph, and 35% of it, the largest factor, is your pay history. Do you pay your bills on time? So that's going to be like, if you think of the negative effects that could factor into that, that's going to be late pays. It's going to be collections. It's going to be charge-offs, things like that. In terms of positives, it's just having your positive pay history. The next section that really matters a lot that tends to get ignored is the credit usage section. And that's just the fancy way of saying the credit card section. And this is the section that wants to see how you are using your credit cards. Keep in mind that there's 2 different major types of accounts: installment accounts and revolving accounts. Installment accounts are going to be mortgages, student loans, car loans. And if you think about the process that you went through, that bank made sure that you were a good risk before they gave that money to you, and they knew how many payments that you were going to make and how much they were going to be. Everybody was very clear on it. A credit card is a whole different beast. And so that's why it gets basically its own section for credit scoring, because they give you a certain amount and then it's just sit back and watch who you really are as you start to spend it financially, right? And so that section makes up 30% of the credit. And really there's some major thresholds when you think about your credit cards, and it's 50%, 30%, and 10%. And when I say that, what I mean is if you have a credit card and you're using over 50% of it, then that credit card is potentially or probably even hurting your credit more than it's helping you. If you pay it from 51% to 49%, 50 is a very real threshold where you'll get multiple and sometimes dozens of points just by crossing over that. Same thing with 30%. And then we like to keep our clients between 5 and 10% to be in the ideal range. Some people just say, I don't have credit cards, or I stick them in my wallet or my purse and I don't use them. That also is not how this credit scoring section works. You have to use it consistently for it to actually help you. So a hack for this one and for the first section, they kind of work together, is that you set up auto pay on some of your services. Think like Netflix, Amazon Prime, the things that you're doing small monthly subscriptions on anyway. You set those up on a credit card for recurring payment, and then you set that credit card to be paid by your bank on recurring payment. So you can kind of automate yourself to an 800 credit score by doing that. The third section of credit scoring is your length of credit history. And that's one where when you have like a Dave Ramsey out there telling people to go out and close out their credit cards and things like that, I don't know that I hope he understands what he's saying, but I don't know that he could possibly, because it's bad advice in that situation. Because what this is it takes all accounts on your credit report and it averages the age. And so if you have a 10-year-old credit card or an 8-year-old credit card or whatever it may be, and you go and you close that out, that is now taken out of that equation, and the average age of all of your accounts becomes much younger, and that drastically affects your credit. And it's not something that you can go and undo. So like in the first section we talked about, if you get a late pay, you could possibly get that removed. If you get a collection, you could possibly get that deleted. If you max out your credit cards in the second section, you could pay those down. If you close out a credit card or close an auto loan, you can't open that back up. And so that's the one where it's only 15%, but it's very fragile, and it's kind of that gold standard. Next is mix of credit, which is the fact that you have to have both installment and revolving. So people who think that they can have just an auto loan or just a student loan, but they don't need credit cards, it just doesn't work like that. You got to have both. And then the last section is new credit, which basically just boils down to how many inquiries you have.
So a couple things that you like, the auto pay thing is a really important thing. Does it it matters too. So I had somebody do this where they would charge like an automatic payment, like a Netflix, right? And then they would pay it like 2 weeks later. And I'm like, I think you're paying it too quick. Don't you have to wait for it to post on the statement?
Yeah, so for credit wise, you actually want a balance to post. And so that's why we tell our clients to keep it in the sweet spot between 5 and 10%. Then you'll get people that come back that are like, no, I'm not paying that interest. It's like, we're probably talking like $2.16 here in the grand scheme of things. But even if we weren't, it's the good credit tax. You're going to pay a little bit in interest for that thing to register. So yeah, you don't want to pay it off so that it doesn't register, but when it does register, you want to make sure you're between 5 and 10%. So if you're using it, like I have credit cards that I absolutely use to strategically on a monthly basis where I run them up, pay them down, and I get a bunch of miles, right? I just know that when and if I'm going to have my credit pulled for lending purposes, that I need to pay those credit cards down and keep them down so that when and I need to do it before like the 10th or 12th, so that when that data is reported to the bureaus on the 15th, that when it publishes later in that month or early the next month, that it's actually the data or the balances I want it to see.
That's a really good tip. So this kind of goes into my next question is, how often do credit scores change? And you brought up like the reporting, when an account will report. So I assume that coincides. Like, do people obsess about their score? I get people all the time like, hey, I just got an email, my score changed 3 points. I'm like, yeah, but we ran your credit 2 weeks ago. Like it's not going to have an effect. Do they obsess about it too much, not enough? How does all that work?
Yeah, I mean, I think I always tell people it's going to be on or after the 8th of the month that you're going to get the true updated batch, because all new records have to be updated by the 5th, and then that usually takes a couple days for it to all update in batch style. Now, that being said, you will have individual accounts update throughout the month, but you'll also see it. And if you check with the bureaus, they're not going to be like, oh, batch on the 5th, like we agree with that. They're going to disagree with what I just said. But what we see time and time again for now about 20 years is that if an item gets deleted, we will have a line item update that doesn't truly have the score reflection until on or after the 8th of the month. So like we'll have somebody pull credit, literally like they'll get the update from us saying these items have been deleted. They jump the gun and pull credit on the 5th, and they're like, guys, we only got like 25 points off of those 4 deletions. And we're like, we know you're going to be annoyed, but you're going to have to clear the social on this and repull a fresh report in 4 days. And if I'm wrong, I'll pay for the report. And I'm not wrong. So there is that batch date, but then there's also the update. They do update the line items, but we see a lag in credit score.
Awesome. Thank you for that.
Yeah, I'm curious. So in the mortgage world, on both of our websites, we have mortgage calculators, $400,000 loan, $200,000 down payment, whatever, this interest, and this is our payment. Is there anywhere where there's actually like a credit score calculator where you can see, like, if I do this, I get this many points, and in any ways to check that stuff?
Yeah, a lot of the credit monitoring services have that now, especially the paid credit monitoring services. We have one that's going to be ready here for launch in the next month. That's going to be our own credit monitoring service that we'll make available to everybody. That's going to have like a lot of consumer what if simulators and things like that. So the things that maybe are getting a little bit out of hand in the mortgage world, we might be able to run some of those scenarios without there being a cost to the lender and it being a very low, if not no cost to the borrower. So, but any like report, if they go into like the tools section of it beyond just the see my report, there's probably going to be some form of a what if simulator. It's just the accuracy of those sometimes can really vary, but they'll at least be knowledgeable about the trends, right? Like if I pay this down, is it going to help me? Yes or no? And they'll get that answer, because again, there are some things where if you would plug it in and say, hey, if I close this out or pay this off, will it help me? And hopefully that thing's kicking back and saying, no, it won't, because there are those things.
So if, like, just for instance, if somebody's got a credit score in the 600s, and I guess it depends a little bit on what's got them there, but what would be the first thing that they could improve to try to raise that?
Yep. So there's a checklist, right? So in terms of it, not in terms of importance, but in terms of immediate impact on credit, you would focus, number one, stop any bleeding. So if you're late on anything, you cannot get any more late pays. Get that account current before it goes to a collection or a charge-off status, or another 60 or 90 days is added on there. So stop any bleeding. Then you would, if you wanted to get the most points as fast as possible, you would probably look to your credit cards and pay those down to those thresholds, 50%, 30%, 10%. Then you also need to do a check for any negative items, collections, charge-offs, profit and loss, or any sort of public records that might be drawing on your credit profile or your credit score. And then if it's a collection or a charge-off that you disagree with, you need to challenge those items. If you don't disagree with them, I would still encourage someone to ask for verification before they paid it off, because those companies do need to provide that, and then get a settlement or a pay for deletion and make sure that those items are resolved so that you don't have to worry about them anymore.
With all of your experience in credit reports, credit scoring models, everything, credit repair, we're talking about improving credit. What's the biggest myth that you want to dispel? What's the biggest thing that you hear?
Well, just even the frustration that like credit doesn't make sense or that it's tough or whatever. It's like, I mean, there's 5 parts of it. There's 5, it's like, we can all do 5, right? Like it's not hard to master credit to the point of where it is truly being a resource for you and your family, where you can exponentially, duplicate what you make on a yearly basis to obtain a home for your family and then create equity, right? Like that's my like soapboxes. If people just understood what home equity was, they'd understand what credit was, they'd understand that it's worth it to know. But in terms of just like myths and credit, I would say paying off collections helps credit. It does not. I would say that there's such thing as a little late pay. There's not. If you add a late pay, whether it's on a $5 account or your mortgage account, those are probably both going to hurt you about the same. The mortgage will have more impact, but I mean, it'll be dozens of points if you miss a $12 minimum credit card payment. It's not little. Plus, that little late payment can disqualify you from home ownership for 12 months or from qualification. So again, there's no such little thing as that. And then again, the credit cards. You got to use them. You got to maintain them. We don't make the rules. We just want to borrow the money, right? If we had the money to buy the house cash, we don't need the rules. And but we don't really get to complain about them if we're literally borrowing hundreds of thousands of dollars of someone else's money so that we can move into a house really quick and start profiting on it. It's like, just play by the rules. They're not that tough, guys.
Yeah, I've got a question as far as playing by the rules. With mortgage rates being, obviously a bit higher the last couple of years, I've seen a lot of people that are, carrying the note and doing owner carry stuff. Is there any way for somebody in that situation to get those payments reported, or no?
Yeah, not as of right now. I mean, you could do like a rental reporting trade line to get something on there, but again, that's not even going to factor into the mortgage scores the way that it should. So unless you got to understand that to report to the bureaus, you have to be set up with the bureaus, which costs a lot of money to report, to even be able to report, and then to report on a monthly basis costs as well. So it just, they don't have the setup for it to happen, and it would be cost prohibitive. If like my buyer wanted me to do it, I'd be like, no, I'm not doing all that with Experian, Equifax, and TransUnion.
This has come up recently with higher interest rates. Tommy just brought up on assumptions. If somebody is to assume a VA or an FHA loan, does that report to their credit? Like if I sell Tommy my house and I have an FHA loan and he assumes my loan, will it then report to his credit, or is it still on my credit?
The financial responsibility should transfer. I'll double check that, but the financial, I believe you sign documents to transfer. If I don't have a ton of experience with that, I'll tell you the truth. So I could be corrected, but I believe the financial responsibility transfers. Now what I don't know if the first person is no longer obligated, if it's like more of like a co-borrower situation, but I don't think so. I think that it's a true assumption, but I'm going to double check on that and get you a for sure answer.
Okay, thank you. Yeah, I believe it is taken off of the seller's credit and goes on to the new borrower's credit, but I've never seen the aftermath of that.
So
I just wasn't sure.
Yeah, and I know that we have dealt with it, so I'll be able to pull some files and show you exactly a before and after. So, but I do believe it transfers, but again, I'll double check.
So I'm curious, is it possible to go from bad credit, say, sub 600 to what we would consider fairly good credit, above a 700 in a year? Is that something that you think is possible? And if so, like, what would you need to do in order to make that happen?
I don't personally think there's anyone that I couldn't take from wherever they're at to mid 600s within a year. It would come down to your budget, your commitment, and your follow through. Meaning, if you're that low, there's a good chance that you owe valid debts, right? I can't pay your debts for you. I can tell you exactly what to pay and who to pay. The question is going to be, number one, do you make enough money? If you don't, then we should probably have the conversation of you filing a BK, to tell you the truth, because that's going to be a faster rebound for you and your family and get you to be a productive member of society that much faster. So assuming that it's not BK though, right? Like everything north of BK, as long as you're listening, I would even say a year. I would be disappointed in both of us if it took a year, because what it really comes down to is making sure that everything is correct on your credit report, which takes maximum of 2 months, right? 2 rounds of disputes and challenges and investigations to make sure that everybody is reporting correctly. If there's something that's not reporting correctly, we're referring them to an FCRA attorney at no cost to them anyway. So there's no reason to not keep moving forward. But more than likely what happens at that next phase is where we say, listen, we were able to get 2 of your items removed, but 2 of your items remain. And 100% you owe them. They legally verified it twice, right? And then the client just needs to know and remember that in the beginning, they said, I'm willing to do whatever it takes to get qualified for a home loan. And right now, I just need you to pay your own bill. And so what we'll do at that point is we'll get a hold of that company and we will negotiate a settlement, but the client has to make good on it and then pay that settlement off or have funds at all for us to make that call, right? And so that's where people fall off, is the part where it's like, I have to do something now, right? And so it's the paying down credit cards or opening credit cards and maintaining them correctly, or paying off past debts. As long as people are willing to do that and they're being realistic with themselves about what it takes to become financially sound and to be someone where a bank wants to lend you hundreds of thousands of dollars, we can go and fast forward, and I can get that process done in 2 months, 3 months, if someone has those things that I can't account for ready to go.
Yeah, I think that's something that people miss out on. And it's sometimes self-inflicted, right? Because you hear a lot of other companies and places that do lots of different things. They chase ambulances, they help divorces, and they fix everyone's credit in 30 days.
Yeah.
And they forget that it's a two-way street, right? One of the biggest things I've learned from you and everyone at your company, My Credit Guy, is it's a two-way street. Like, when you are doing an interview with a client, one of the biggest things I took away was like the professional, the credit professional is talking to them and letting them know what's going to be expected. Like, here's what we're going to do for you. But then, Sam, like you said, like, here's what we're going to need you to do. And we need to make sure that you're committed. And the reason why we're needing, if you want to buy a home, like, we're going to show you how that's possible. I've personally had clients with you that you've in like 3 or 4 months have raised their score 80 plus points. I mean, just remarkable. You've also done consults with clients and given them just a straight feedback that they need to hear. And maybe it's not what they want to hear, but you know what? They're in their situation they are, and someone just has to be honest with them.
Yeah.
And they have to get to the point where they're committed to bettering their situation. And so I think that that's a big thing, because you hear a lot of gimmicks in the credit repair field, you know, in just the industry. And there's no quick fix. It does take a lot of work. And you guys outline what is involved in that. One of the things I like too is it's not a set it and forget it thing. You guys are doing a lot of work behind the scenes, but you constantly update the client, you constantly update the loan officer, and you even constantly update the realtor. And the real estate agent is the key one, because many times I've talked to agents and they're like, yeah, everybody I refer to credit repair, like, I never hear anything about them. I don't know if the loan officer sends them somewhere else or it's not successful. And I'm sure it could be a little bit of both, right? And so I love how you set up those systems. Can you talk about why that's important to your company and to you guys to keep everyone updated throughout the process?
Yeah, absolutely. So, I mean, I'll just be honest with you. Credit repair clients and the loan officer's relationship with them can be a little fragile, both of them, meaning a credit repair client's a little flighty. They're going to go in a lot of cases where they think they can get their family a home, and God bless them, right? Like but they're on edge. Okay. Then you have a loan officer who this deal is not the one that they were hoping for, right? Like, they love the 720s conventionals that, you know, just line right up and they're beautiful. And so what we understand is that if I'm going to make sure that your client gets back to you with both of those factors in mind, then we have to account for that with communication. We have to over communicate, because everybody is going to leave every situation, every conversation with this question: what's next? What happens next? And so if you don't answer that question for both people, then they start filling in those gaps themselves. Rene Rodriguez calls them narrative gaps, right? And so if we don't let you know, let the client know, and let the group know what happens next every time, then you get a client going, you know what, maybe I will fill out this app. It's pretty easy, and I see it on football games. Or, you know, you get the loan officer who stops connecting with that client, and then the client rightly in some cases goes, okay, I'm going to go over here then, right? And so we understand that we have two different sets of clients. I have to make sure that you get closings, but I have to deal with a loan officer's sometimes prioritization on other files, or in some cases, lack of systems. And then I got to deal with a credit repair client who's here, there, and everywhere, right? And I want success. I want my loan officers to close loans, and I want my clients to close loans with them. And to do that, we just have to over communicate. And so, long answer, but that is why. Because if we don't do any of those things, if any one of those things is left out, we don't get the closings that we get.
Yeah, I've never had somebody say, "Gosh, tell the credit people to stop updating me." Like, no, everybody loves it. Everybody loves it, and so you guys are really setting a standard for that, which I love. My clients love it, the agents love it, everybody involved really appreciates that. We also like that you're willing to do like a no obligation consult with me and the clients. I have one this afternoon at 3:15, just because I already have a relationship with the client, right? And they don't feel like I'm just like tossing them some stranger. Like, we're all going to get on a video call, and we're all going to discuss the situation, and we're going to set proper expectations, and to do that together, I truly means we have a team for that client. And people realize that, man, in an industry, mortgages and credit repair, I'm sure that's very transactional. People pick up on the fact that it's not a transaction. Like, we understand they're people.
Right. Yeah, it's just, I was always taught, act like it. Like, if you want something, if you say you want something, then the actions have to come behind it. And when we got into credit repair, I always said, like, man, I wish people would take it more seriously. They're in the mortgage process. Why don't they take it more seriously? And then I looked at what most credit repair transactions or companies look like, and it's like, well, no wonder. Like, they don't have a portal. They don't keep people updated. They don't give you a dedicated credit coach. So, like, none of that seems like you should pay that much attention. And so then that's how we built My Credit Guy. With that is like, well, if we want people to take it seriously, let's take it pretty seriously. Let's try to be as good or as close to the mortgage experience in terms of technology and user experience and professionalism as we possibly can be. So, yeah.
Perfect. I've got a question, and we'll kind of circle back to what you said earlier. I've got a client right now. They're going through the bankruptcy process. Like, they had some medical issues, things kind of got out of hand, and this was just kind of the best solution for them. But what do they do to get back? Like, do you guys have tools? Do you have, like, how do they reestablish their credit? Like, what's kind of best practices there?
Yeah. Number one, they should have a lot of hope, because when discharged correctly, both through the court and through the credit bureau, it really can be a fresh start. If not discharged correctly, this is what's going to happen. All of those items that were included in the BK are going to say item discharged, zeroed out in most cases. Sometimes they keep a balance when they shouldn't, but a lot of times it's discharged. But now is where we get into this behind the scenes rating system that's called the MOP rating system. And I can give you a document on this, but it goes 0 through 9, and it rates it from 0 is too new to rate, 1 is on time, 2 is 30, not yet 60, 3 is 60, not yet 90, all the way down to a 9, which is a collection, charge off, profit and loss. Okay. When something goes through a bankruptcy, it is supposed to be recoded as a 7, but it very rarely is, because that would take the company that just lost all the money through the BK to go in and do this behind the scenes little rating adjustment. Well, when they don't, you got to keep in mind that the credit scoring algorithm with collections especially doesn't see and doesn't care about dollar amount. It's not looking at balance to limit ratio. So on a BK, when you file a BK, in a lot of cases, all you've done is you've updated the date of last activity on that thing, just like paying a collection off. But the 9 stuck with it instead of being updated to a 7. And so you got no relief credit wise. So then that client will sit there for years because the notation on the report says included in BK. So the client's like, I mean, it says it's included in BK. Why are my scores still low 600s? And it's like, well, because the behind the scenes says that you still have all of these negative accounts and it's not accounting for the BK. So what we would do with that client is we would go through, address all the items that were included in the BK. Sometimes just by going after them, they do get removed because the companies go, we're not spending any more time on this thing. Just take it off. We can't really control that. So my point is you do get some deletions in that. But at the very least, what you would get is those accounts updated from a 9 to a 7. So then the client can really start rebuilding with the higher credit scores. Then we would get the client a secured card, a $200 secured card. We have one that's the credit builder card. It reports to bureaus within 3 weeks or so and will help establish credit very quickly. We'd probably have them get 2 secured cards and just start paying on those for the next 6 to 12 months. And then they would start stepping up in credit cards until they probably had 3, maybe 4 credit cards max, and then just hang out. So, yeah.
Does the amount of the credit limit actually affect your score? Like if somebody gets like $1,000 versus a $5,000 secured card, or does just the $200 card work?
Great question. And this is why I get geeky about the credit scoring algorithm, because this is the part that's beautiful. It's all just about how you treat what you're given. So some people be like, oh, only rich people have good credit. It's like, stop it. It's not like that at all, because it's all about the balance to limit ratio. If I have a $200 credit card and I only keep $20 on it, and even though I know $20 is annoying, but it just is what it is. This is to build my credit, not to spend money. If I keep $20 on that, I'm at 10%. If the rich guy has a $20,000 credit card that he has at $19,000, he is maxed out on that thing and has probably a lower credit score than the guy with the $200 secured card that he keeps at $20. So it's all just about what you do with your opportunities. If you got a car loan, did you ever go late on it? Not how much it was. The credit scoring algorithm doesn't care that it was a $8,000 used car. It just wants to know, did you make your payments on time like you said you were going to? And if you have a credit card, no matter how big it is, do you keep it below 50%, 30%, 10%, or not?
Yeah, that's good insight, because a lot of people don't understand how that works. That it's the ratio to the limit to the balance that you carry. It's not just the full on dollar amount that is available. Talk about the myth of 800 credit score? I always kind of chuckle, because I get a lot of customers that, if they want an 800, but they might not understand that the way mortgage scoring systems work, if they're a 780, they're probably getting the exact same pricing as their spouse, who would be an 805, or their friend who's an 805. Is the 800 a myth? Can you talk about that? What do the scores range from? Can you tell us that?
Yeah, so they go anywhere from 350 to 850. But there's different scoring models out there that really don't matter that much, that can be lower than that, higher than that, or kind of rein it in more too. But I mean, that's your general range, is 350 to 850. Now, once you get up above 780, like you said, it's just kind of like bragging rights for the most part. But there are some things that would take somebody from a 780 to over an 800. But there are also some things that, like, there's not much you can do about it, because when you get to that high, you're usually dealing with needing some lengthy accounts, right, that you've had open for quite a while. You can get up into the 700s pretty quickly by just having good spending habits, right? And that's why a lot of pricing maxes out. Like, even if you get over a 720, it's like, how much better can we even get from here, right? But to get up over that 800 is usually going to require proper mix of credit, so both auto loans and revolving, but with a strong emphasis on revolving. Some good solid credit cards that have probably been open for 10 or more years if you're going to get up into the above 800 range. Otherwise, you're going to have a lot of accounts that, I mean, if you had younger accounts, you're just going to have a lot of them that are perfect. But even then, you're usually going to max out right around that 800 range. You got to have that length of history as that kicker. And remember, that one's only the 15%, but it's the one that I said is kind of gold. And that's part of the reason why too, because without a nice old account, you're probably not going to hit that top tier.
That's good.
So what would you say, what advice would you give to somebody who's 18 years old, they're a ghost, they have no credit profile? Like, how are we going to establish their credit, and how quickly can we get it to a point of going from zero profile to being able to own a home and be a first-time home buyer?
Yeah, so I guess my first question would be, are you going to be a student? Or are you going to have student loans? If you're going to have student loans, then you're automatically going to have your installment taken care of. If you're not going to have your student loans, I would probably advise you to go to your local bank and get a low interest starter car loan. If you have a car, even if somebody's like, I have it paid off, it's like, well, I don't know, refinance it, get something on paper going. You can also get like the little starter loans from banks like that show up as installment loans too. So you could do that as well. Some banks have like a CD option that pays in and it shows up in an installment. One way or the other, you need to establish an installment loan. Then I would probably get 2 starter credit cards. I would have one if I had time and wasn't in a huge rush. I would do the secured card, the $200 secured card. If I had a parent that was well off or doing well on their credit cards, I would probably sign on as an authorized user on 1 or 2 of those if they would allow me to. Those are a whole touchy subject. I don't recommend that anybody but immediate family or business partners be added on as authorized users. Just saying it. And absolutely never buy an account to be an authorized user. But anyway, I would probably add one if my mom or dad would let me, because that's going to be a big bump. And then after a few months of letting those accounts soak on my credit report, probably get me up into the mid 600s, I would then apply for my next credit card. That would probably be unsecured. And then I would stick there with a secured card and unsecured card, 1 to 2 installment loans, and then set myself up really nicely for my first home purchase.
So I want to, on that subject, this is something you guys taught me and taught my clients, but not this particular client. I have some very long time family friends. Met the child when he was 7 years old. He due to amputation reasons, but he's now 18. Going to U of A. Parents wanted to buy him a condo instead of renting like an apartment or a condo. They're like, we could just buy one. So they're like, we're going to buy one for him. I'm like, well, you live up in Gilbert. Like, here's how that would transpire, kind of going all those things. I'm like, does he have any credit? And they're like, well, I think he has a small credit card. So I pull his credit. And this is at the very beginning of the shopping thing. And he's like a very low 600 score. He has 1 small credit card and 1 student loan. So you touched on the student loan being the installment thing, right? And I didn't know that. And so I'm like, hey, I get it. You want to buy it for him. But if we were able to get his credit up there, technically he could go on the loan because he does have a disability. And there's a thing with Fannie and Freddie that parents can buy a property for someone either elderly, like a parent, or a child who cannot work due to disability. And that can be a primary residence, and it will save you a lot of money because it's not a second home or an investment home. You guys aren't going to live there, so it's not a second home. It's going to be an investment home. It's a rough situation. So I was like, if you're comfortable with it, exactly what you said. If you're comfortable with it, what I would do is add him as an authorized user to one of your credit cards, and I can look at your credit report and tell you which one would be good. Like they had, I think it was like a USA card, like $20,000 limit, like $1,000 charged on it, and I'm like, you could add him to this as an authorized user, and it will give him the full credit profile from your card. You've had the card for 10 plus years. There's almost no money on it, but you carry a small balance, which is good. Parents were like 760s credit score. So we do this. Our shopping goes like 4 or 5 months, a lot of non-warrantable condos in Tucson, College Town, right? And so we get under contracts. Then I go to pull his credit. I'm like, well, let's see how that worked out. He was like a 779. The parents were like, his score is higher than ours. And I was like, he just doesn't have a lot of credit. But now he has 3 accounts. Now he's a high 700 score. And I'll never forget, I was on the phone with them, and I didn't know he was in the car. And then I'm like, you can add him to the loan now. And literally, and they're like, what would that do for him? And I'm like, after a couple of years, he's going to have the full mortgage history. Like, he's going to be a high 700 score. He's got a mortgage. He's got an installment loan. He's got a credit card. Like, he could go buy whatever he wants. I'm like, maybe don't tell him that. And they're like, Logan's in the car with us. And I was like, oh, sorry, buddy. I'm like, but seriously. So we closed that loan. But this is where coming and talking to a professional who doesn't have like commission breath or who's not transaction oriented, I think people miss. Like, my credit guy, Sam, you and all of your team, everyone I've ever met or talked to, like, you're there to help people. You're here to educate people. You're not just looking for a transaction. And so that's what I think people miss. Like, they're willing to go talk to a doctor if they're sick. They're willing to talk to a mortgage professional or a real estate agent if they want to buy a home. But if they need help with their credit, they talk to their buddy who has good credit. And like Joe Blow doesn't know how to the whole algorithms work and the scoring models and all those things. They need to talk to a professional. What advice would you have for someone who's, they're trying to build their credit? Maybe they do need credit repair, don't need credit repair. I mean, what advice do you have for those people? Is it talk to a professional? I mean, is it call you guys and do a free consult?
Yeah. I mean, I would love to defend my industry and say, oh, they should just seek out any credit repair people. But I will say that probably a lot of the reason that a client is hesitant to reach out, or that loan officers and mortgage professionals and real estate professionals have in general given the advice to not seek out credit help, right, is because we had some bad players. You have the biggest companies in the credit repair space, Lexington, being sued for billions of dollars, right, by the federal government. And that's what people associate credit repair with. What I'd love them to do is just a little bit more research and start associating with us, because if done properly, it can be a game changer, right? Like, people look at their credit right now as a stress and a problem. I and our clients and you and people that understand it look at it as a huge tool. I would never want to go into a transaction without using my credit, because I get so much more than I can bring to the table just with dollars in my bank account, right? And so they just need to do some more research. They should talk to a company and make sure that company is obeying the law. You can't charge upfront fees. If they're telling you crazy stuff like they can get everything removed, that's a red flag. Don't talk to them anymore. And more than anything, just ask your lender, who have you actually had success with? Not who do you get a rip by sending a client to, because there's a lot of loan officers out there that are like, oh, I send to this company. It's like, really, how many loans have they gotten back for you? Well, none, but I get $75 per transaction. And it's like, I don't even know where to start here. So ask them point blank, have you closed a loan with a client in a situation like mine because of this company? And if the answer is yes, then I would give it the time of day. If not, call my credit guy.
Yeah, that's a very key thing, like getting the kickbacks, or what success if you have. Anytime I talk to someone about my credit guy or just doing a consult with you guys, not only do I tell them about the success that we've had with clients, but I also tell them, and this is, I think, what sets your company apart, is I know you and Jesse and Trisha, and know many of you personally.
Yeah.
And I can vouch for the type of people that you are. And that transpires to the business that you run and how you treat your clients, because you do understand that they're people. And you do understand there's families behind this. And while you are very direct and upfront with them and tell them what's required, you do understand these are people. And I think that's something that truly sets you guys apart in such an industry, even mortgages, right, where people are just chasing the next paycheck. It truly sets you guys apart because you do right by people, not just with your results, but how you talk to people, how you treat people, And so I really commend you guys all on that. Everyone in your company is the exact same way, and it's from the top down. I mean, you and Trisha set the example for how people should be treated, and so that's a big thing, because I know credit repair gets, it's a scam or whatever. There are some bad actors, and there's some bad actors in the mortgage business years ago and still to this day. And so I think it's important for people to talk to you and really hear what you have to say and see, trust their gut, see how they're treated. One of the biggest things is, like I said, never have been on a call with somebody from your company, a credit coach, where they're like pushing and selling the credit repair. It's almost the opposite. They're just being very detailed in what could be accomplished, the timeline on what could be accomplished, because the timeline is something else. I think that it varies, right, from client to client. Like, if I have a bunch of collections that I got to get off my credit and we got to negotiate settlements, like the time for my credit repair might be different than Tommy's. Is that correct?
For sure. Yeah. I mean, it really is. Like, when somebody's like, how long is this going to take me? I'm like, it's up to you. Like, I mean, I need a month, 2 max to do investigations for you on your items. But other than that, like, there's so much where it's like, all I'm doing is investigating your item. Like, when somebody's like, anybody can do that on their own, it's like, yeah, I mean, you could if you knew exactly and you had the time and you wanted to experiment with it. But on that same note, like, I'm just doing an enhanced job, a service, right? It's just a service. Like it's like so many services that we pay for. I know what I'm doing, how to do it quickly. I have it scaled. I have a system to do it, but it's all your stuff and it's all up to you. So I'll investigate your stuff. If anything's wrong or not supposed to be there, I'll get that removed. I promise you that. And then after that, I'll settle out an item today if you want me to. Actually, right now, I'll get on the phone, I'll call that company up, and you can be done with my service today, and I'll settle it out. But do you have the funds to pay that, right? And so it's entirely up to someone's own discretion at how fast we can go, and obviously their budget.
It's a two-way street thing, right?
For sure. But I will always meet you in the middle. Like that's the thing about our company is, and I tell people, I'm like, this is a two-way street, but I will always be there standing in the middle. I will never be the one not there. And so as long as you show up and you meet me in the middle, we're always going to get stuff done. But there are things that I can't do. I can't control your bank account and I can't control your spending habits. As long as you will follow my lead for the next few months on those two things, I have no doubt that we can get you where you need to be in a very quick amount of time.
Sam, I've been using you guys since I think 2019 was when I first started. And I think one of the biggest underutilized aspects is not using your company as like a credit coach. Like I think there's a lot of people that look at credit repair and say, oh, that's only for people with really bad credit. But the difference in our world from taking somebody from 660 or 680, which, not that bad, to a 740 or something can mean the difference of $150 to $500 a month on their mortgage payment.
Yep.
What are your kind of your thoughts on that?
Yeah, I mean, there's not. I've thought about changing the name several times or creating another entity so that people really did see what we are, which is a coaching company that can also help you file expedited disputes and investigations, right? But at our core, what we are is we're a bunch of people that know credit really well, that are very passionate about getting people qualified for home loans. And so that being said, whether somebody's at a 450 and really needs a beginner course and some intensive help, or you're at a 750 and you argue with your spouse about who has a higher credit score, I can tell you how to get a higher credit score, no matter where you're at. And it will benefit you, and it will benefit your family, and it will benefit your finances. And so I do wish that everybody would just go, hey, take a look at my credit and tell me what I can do to improve it. I mean, we don't charge people unless it's like we have to go to work for you. And even then you have to agree and say, yeah, I want you to go to work for me. So to look at your credit and to tell you how to get those next 50 points costs you nothing. And we're willing to do it all day. So.
Yeah, I think everyone should have some sort of credit coach. In the world of football, Tom Brady had a coach. He had a nutritionist. He had, whatever. And I think in the financial world, we all should have some form of somebody that has our back and is looking after kind of what we do. It's something that's so misunderstood.
Yep. Yeah. There's so many just situations where people are like, what about this? And it's like a ripple. It's like two of those, what it ends up being, as we talked about that pie graph of the scoring algorithm, is it's like, well, what you're describing to me is like 1 and 2 overlapping onto 4. So what we have to figure out is how these things all work together. And no, you actually wouldn't want to, like somebody coming and saying, hey, I'm going to get a bonus and I want to pay my auto loan off sooner than expected, right? And so we have to walk them through. Like in some cases, it's like, yeah, sure, that's a good financial move. But credit-wise, you're parting with funds faster than you have to and ending an account, right? And so anyway, there's just so many situations that where it differs just a little bit, where it's like, wait, did you say you're also going to pay off your credit cards? Now we're talking. So yeah, there's just a lot of those where somebody's like, here's what I have to work with. Here's who I'm trying to be. What do I do? And then we can put together a nice little game plan where it's like, spend this money, save this money, transfer this account, close this one, open this one, all that good stuff, depending on their timeline.
What's the new thing with medical collections? I saw some things on the news or something about that.
Yeah, they're out. So they had already been tightening it up a lot to where you couldn't have under a $500 medical collection on there. They had to give you up to a year before it was going to be reported. And this new law just says there's no medical debt that can be reported. Now, I have my own opinions on it because I do think that the credit report is to show personal financial accountability. So I definitely think that there is some refining that should happen. But as of right now, it's saying that within, I believe it's 60 to 90 days of right now, because it's like 60 days since after it hits the register. And I believe it has hit the register. So within 3 months or so, we shouldn't see any medical debt on the report. Now, I love that in one way, because I have had so many clients where I'm dealing with somebody who's like, everything was fine. And then my kid got cancer. And then now I have to file a ban. And I'm like, I'm so sorry. All I can do is walk you through this, but yeah, like that's horrible, right? And then you have somebody that's like, I went and got a BBL and I don't want to pay for it. And it's like, those two cannot be protected by the same law, please, right? And so I don't love it for some cases for accountability, but I absolutely love it for people who are getting sick and it ruins their life. That shouldn't happen.
Yeah, I think, life happens, right? Like you don't plan for emergencies. Yeah. And again, this is where talking to a professional, talking to you guys, having a no obligation, credit coach who can walk you through like what's possible. Stop being the woe is me. Like you're not. It's not a life sentence, right? Like, Sam, I'm sure you've seen, very low credit scores get completely changed by people willing to put in the work, follow your advice. And so too many times I think people get an idea it's like a life sentence, right? They're stuck with bad credit for the rest of their lives.
They at least think 7 years. They got that stuck in their head that, for 7 years, Mike. And it's like, that's only if you just wait for every single thing to fall off your credit report and you think you're not going to get sued along the way. It's not going to work like that. It's going to work faster than that one way or the other. Either you're going to fix it or can fix it faster than that, or you're going to have creditors knocking on your door a lot faster than 7 years.
Yeah.
Sam, we want to be respectful of your time. And before we get out of here, though, I want to touch on one more thing, and that's the new kind of Vantage scoring system and everything that got put in place with Congress. I know that's changing a lot. We don't really know a whole lot about it, but can you fill us in, at least from an insider's view, kind of what's changing, how's it going to affect people, and why are we even doing this?
Yeah, in my opinion, I don't love it. I'm just going to say I don't love it. I think it made a very simple system more complicated. We could have just invested in education and making sure that there was no discrimination in lending, right? Like those are the things, because what it was built supposedly in response to was people saying that they did not have opportunities to obtain credit, right? And because of that, then they wanted to make everyday things like rental reporting history, electric bills, cell phone bills, things like that report to credit. But I would ask the same people that say that they don't have access to the others, like, is your rent, cell phone, and electric on time all the time? Because if it's not, this isn't going to work the way that we had hoped for it to work. It's just going to give the credit scoring algorithm a lot more opportunities to ding somebody, because for every way that they can be helped, they can equally be hurt, or not even equally, more so, right? Like one late pay, you can pay on time on something for 2 years, and one late pay drops your scores 50 points. So I don't love it. I don't love it just because I think it sets up more opportunities for a client to fail. And I like for success to be simple. It's going to take into account, though, again, monthly utilities, things like that, rent. It's going to look at things a little bit differently. It's going to weigh. I'm sorry if you're hearing these birds out here, guys. I
heard the rooster or a chicken out there.
There was rooster. Now I got guinea fowl making their way around. It's a zoo out here. But my point is they're going to do trended data now. So trended data means where right now, if you would, I'll shut the window. That's what I'll do.
It's all good.
So trended data means that they are going to look at your payment trends up, down, and do you carry a balance on credit cards from month to month? And in this new scoring algorithm, you would be dinged if you carried a balance from month to month. So you have people tons of people right now where when it's time for a mortgage, right, what are they doing? They're paying down their credit cards a month or 2 months in advance so that their scores jump up. And then once that goes through, then they kind of go back to using the credit card as they did before, and just again preparing for the next one. Well, with this, if you carried that balance from month to month, it's going to go back and look at that trended data and the average, and if you're paying your card off every month or if you're letting it go. So that way the rapid rescores that you guys do right now, where we're just like paying a credit card down and then rapid rescoring them, that won't work, because they're going to look at what the last 2 years averages were of balances on month to month, and that's what they're going to look at. So there's just a bunch of things where I'm just like, so how does this help the consumer? Like, I can get how the people that probably put it together, like who promised they're worrying about consumers, I can understand like where they were coming from, but then I also know enough to go like, that doesn't help. That's not going to help. So we'll see, guys. We'll see. It still has to be put in place, and then it still has to be adopted. And we got Trumpster coming in, so he could, who knows what wand he waves and says never mind, or if it's too late on that, it's absolutely happening. But we've seen a lot of things hyped before and then not followed through on. So we'll see on this one. But they say it's happening. They say it's absolutely happening.
I think we need politicians to talk to experts also, just like consumers. Maybe before they start putting some of these laws and things in place, they could talk to Sam Parker and My Credit Guy and get some true feedback instead of just throwing a dart at the.
Yeah, and they say that you're gonna be able to choose between Vantage 4.0 and FICO 10T, and so then that's gonna give the consumer an advantage. And again, like I'm just like, have you guys done mortgages before? You know how all this works? Like when it's actually in practice and it's actually happening. So yeah, we'll have to see. But I hope it ends up being great for the consumer. I really do. I'm unfortunately seeing some holes right now.
Sam, how can people get in touch with My Credit Guy? How can they reach out to a mortgage coach? How can they get in touch with you guys?
Yeah, so they can just go to mycreditguy.com and just fill out the contact us form. My email that you can get straight in touch with me is sp@mycreditguy.com. And you can always reach out directly to me. I might not be the one to get back to you, but one of my team will, and we'll do it very quickly. So you can always just reach out and say, hey, free review, or I want to know more, or whatever. But yeah, mycreditguy.com or sp@mycreditguy.com.
Awesome. As we end this, if you could give 5 tips to anyone, what would be your top 5 tips for maintaining and increasing your credit score?
I would say credit cards aren't the enemy. Open them and maintain them correctly. I would say automate as much as you can. Put things on auto pay. I would say check your credit every month on top of the auto pay to make sure that there's no past due balances and to just understand what's going on. I would say if you're going to consider a mortgage in the next 2 years, to identify and speak to a mortgage professional now so that you're planning accordingly, so that nothing comes up at the last minute that you weren't thinking of. And number 5 is don't co-sign for anybody, especially as your credit gets bigger and better, unless it's your wife or husband or spouse. But don't co-sign. People will come out of the woodwork as your credit's getting better and asking you to co-sign. They are not your friends. They're probably your family, but they're not your friends, and say no.
Yeah. Well, that's awesome. Well, we appreciate you, and keep posting those pictures of the hunting, the birds, the chickens, the farm life. I love it.
Awesome, man.
Right.
Awesome. Well, you're welcome anytime. Come on out to the farm. So, but thank you guys. Thanks for having me. I really appreciate it. And this was fun. And anything else you ever need, you just let me know.
Thank you, brother.
Thanks, Sam.
Go Hawkeyes.
Go Hawks. Thank you. Bye-bye.
Bye.